If we leave Brexit to one side, I mean, I know everything's interlinked, but we actually had some worse than expected UK GDP figures today. Yep. So do we just assume that the trend for GDP is just going to get worse until Brexit is resolved?
Well, I mean, at the train left the station with regard to business investment and uncertainty regarding business investment, shortly after the referendum. And although there's been a lot of political discussion all along here, businesses had to make decisions. And so they are. And we see that in the data. And whether Brexit is resolved or not, an awful lot of those decisions are in train. And they're not irrevocable. But once business has decided to move locations, it's kind of hard to do a U-turn on that.
Okay, as a chief economist, you have to almost take a political stance. I'm not a political stance, but how much of it is political? And actually, if you look at Theresa May, she has 5 options left?
Right.
Which one is she going to take?
I'm not sure about 5, but
there could be 12?
Right. No. Well, so I mean, the obvious option is to have a stopping of the clock on March 29th and have an agreement that to continue on with the negotiations. Now that looks good from a political standpoint, or it looks better than a crashing out, both from an economic and a political standpoint. So it is better, but the erosion of businesses' attitude towards continuing to engage with the UK as part of the EU, that erosion continues. And we see that in the data now. We're going to continue to see that. Crashing out would be worse because it would have a lot of financial market implications that would be very dramatic.
Catherine, one of the clear trends of the last 6 weeks is disinflation in Germany and continental Europe. What is the character of that disinflation?
So a couple things. First, we do have, on the other side, wage inflation, and that's a good thing because it is supportive of the European area and it's supportive of growth in Europe. It's a counterweight to what we see in terms of the industrial production in Europe, and of course that has been weakened dramatically on account of the weakness in China. So the two of them are offsetting each other now. Not as much as they are in other places, but so we have robust consumption, weak industrial production, and the sum total of those is weakness on the PPI side, the intermediate side. Some of that's due to oil, but rising wages. So, we still have, if you put those two together, you're actually looking at higher real wages, and that's a good thing.
Can they clear markets after a 20-year experiment? I mean, without a fiscal union, with a fractured monetary union, with Euro dynamics that affect different countries different ways, does Catherine Mann have an optimism that they can clear markets given crisis?
Well, everybody seems to think that Europe does best in a crisis. I don't think that's great from an economic standpoint to wait for a crisis in order to undertake the reforms that are necessary to move forward. But if that's true, it would mean that there'd be a silver lining. I think that you've set out a range of issues that have been a feature of the euro area since its inception. Some issues with regard to differential business cycles in the various countries, differentials in their fiscal policies or attitude for fiscal policy, differentials in the way the labor market works, the extent of fiscal union, the extent of banking union, the extent of services union. So, you've set out a whole range of issues that have been part of the euro area from its inception. So this particular time right now, really the external environment is the one that's making it particularly challenging because it's this tension between the domestic and the external.